What's up, everybody? I am back with another edition of the Sunday Scary Stock Talk podcast. But first, before we get into it, I'd like to thank our sponsor, Financial Stock Data at financialstockdata.com. Use promo code GCI as in Green Candle Investments and get your first month of their premium service for free. And so that premium service, you can research any kind of stock, add them to your watch list, put them on your radar. If anything kind of changes in that stock, maybe a certain metric hits, you're looking for a certain PE ratio or something like that, Financial Stock Data will send you a notification, and then you can determine whether or not, you want to buy or sell that stock. So, like I said, financialstockdata.com, promo code GCI. So be sure to check them out. And now to get into the episode, I have a very special guest, Gabriel Kaplan. Gabe, how are we doing today?
Good, you. How are you doing?
I'm doing great. I'm doing great. So let's get into it. So tell me a little bit about yourself. I think I found you on Common Stock. You have a lot of great great posts and everything like that on there. But yeah, let's get into it. Tell me a little bit about yourself, how you got into investing, and yeah.
I want to say I got into investing after my first job. My first job was in investment banking. I worked at Merrill Lynch before they became Bank of America. It was that summer, 2007, where I got the internship. And then they offered me a full-time job. Started in New York. Financial crisis happened. I got basically, there's a little story here for most international people. They don't know it, but if you worked and you were about to get a work visa in the US, working for an American bank, and they received TARP money, that was prohibited under TARP. Like, they could not issue new H-1B. So everybody was shifted towards their home office. I grew up in South America, but my passport was Swedish. And so they shifted me to London. I was supposed to go to one group. I ended up in another. I didn't like it. So I ended up trying to find a job in the US, eventually found one, moved back to New York. And so after I moved back, I started investing there was less scrutiny, less rules about what you could do outside of banking. And so I started my investment account and I started investing. It's a great time because it was post financial crisis. So it's been upwards and onwards since then. And I started my own registered investment advisor back then. I was working for like a small family office slash kind of like an administrator for hedge funds. So I got permission to open up my own investment advisory firm. I was doing it part-time for 10 years and then finally was able, to get enough assets to do it full-time. So for
That's
anybody
awesome.
for anybody who wants to manage money and doesn't want to start that, there's two routes, right? The fund and just managing individual accounts. If you want to manage individual accounts, let them know, contact me. I'm happy to give them some guidance.
There we go. That's awesome. So let's take it back a little bit. So you kind of mentioned that you started investing or getting into it based on your first job. Was there something kind of, maybe growing up or something that you can kind of think back to that, really was like, okay, I need to do this in order to grow my wealth? Or was it just kind of like, hey, it was, this job kind of fell in your lap, or whatever, it kind of worked out and that's kind of how you got into it? Was there something that you could kind of like point back to that you can kind of think like, okay, well, because this happened, this is why I started to invest?
I'll tell you one thing. The first memory I have from investing was watching like CNN or something like that with the dot-com bust. That's the first memory I have. I was always interested in investing, but I studied engineering in college, and my goal was to work for the defense companies in the US. But little did I know that you needed to be a US citizen or a green card holder. And so next to that booth where the defense companies was some banks, and the banks had no restrictions who they would hire at that time. And so it kind of fell in my lap. As most people post college, I would say most people don't really have an idea. And that's why I would say most people don't like their first jobs. But once you get the first job, you have more an idea of which direction you want to do or go. I would say investment banking is not a place I would have chosen. But it was definitely an eye opener to the investment world. It was also an eye opener to how you value stocks, how you look at them, how different companies look at different companies, because that's, I guess, the essence of investment banking is trying to pitch companies to buy other companies, or do some sort of transaction. And so I think that was an experience in itself, and that really helped me with with investments going forward.
That's awesome stuff. And yeah, from what I hear, the especially early on in investment banking, they work you like a dog too. So good on you for making it through all that, because from all accounts that I've heard, it's
Well,
definitely not easy work or anything like that.
I'll be very clear. I did 1 year, and so most people do 2 years. The problem is that I got to London, and there were three. The first wave of layoffs, then the second wave of layoffs, and I wasn't chosen for the second wave. And at the second wave, I was like, if there's another wave, I'm it. Like, this is me. You can't survive three. That's very lucky. And apparently, I survived the third, but at that point, I already had a job offer, and all my friends were in New York. And so I just flew back.
There you go. Well, hey, now you're here. So,
Yeah.
you started putting out content, investing related content. Beyond Returns is your YouTube channel. So for everybody out there, you should go check that out. But what is your, I guess, overall goal? Like, what kind of drove you to start putting out content based on investing and all that kind of stuff?
I think so. I work alone, and the problem with working alone, more or less, is that you don't get feedback. And so it's pretty good sometimes to just put yourself out there, put content out there, get feedback, get good questions, get pushback. It's that back and forth that really gets you to the right answer. And so if you don't have that, then you just have to find other ways. Beyond Returns is more like a fun hobby, I would say. It's I do it with another co-host. It's Robinson Crawford. He's another financial advisor. He's much more of the planning person. More opposite to me. He believes more in like efficient theory. Like he's more of an index person. I'm more of an active investment. So we have like a little bit of opposing thoughts there, and so I think it's good to bounce ideas off him. But in general, if you're working alone, I think it's like you must get pushback from your ideas and investments. Like, otherwise, you're handicapping yourself.
Yeah, no, I agree with you 100%. And I think the cool thing about, the time that we're in now is we're having a lot of platforms pop up left and right, that allow you to post your ideas. And not only that, like kind of get criticism, critiques, however you want to word it. And, really there's a lot of sharing ideas left and right. And so, I know you're on Twitter and in Common Stock. How do you kind of view those platforms and view, sharing your ideas and the overall, like, sharing of investment ideas back and forth? Because I know, like, Common Stock, it seems like it's pretty positive because it's more long form, but FinTwit can be kind of a
Yeah.
ruthless place as well too. So kind of how do you view those two platforms, and how do you view like sharing the investing information, like from peer to peer, from people you really don't even know?
Yeah, I would say before I even start, downloading the 10K or anything, I look for other people who have done the research. And so I will actually go to Google and search the Substack domain, and I will search for the ticker, right? That's the first thing I do. And then I ask anybody on Twitter, or like I try to push, search there too, if anybody has done any work on any specific stock. I think those places are great, but the more intimate communities are, I would say, Common Stock. I actually am part of some Discord groups that are more of like value investors, not the pump and dump crypto that is, commonly associated with Discord. Uh, and I have some people I talk to regularly, but I think overall, if you want to like separate the social media aspect, it's like you have Twitter is like so open, it's so big, everybody's on there. You have actually pretty famous investors, pretty active on Twitter, and there's a ton of hedge fund analysts on there that aren't using their real name, obviously. So you know that there is a group of smart people on there. You just have to develop somehow a relationship, and it's difficult. I would say it's not easy to just like come in and develop a relationship. Plus, I'm listed there with my name. I don't. There's a lot of people who are anonymous. Um, I, Overall, I think these are all good things, but at the end of the day, you just have to do your own work.
Yeah, exactly. And I think that's the biggest thing, right? So, no matter who you follow, influencers, whatever, hedge fund managers, I think like at the end of the day, it really comes down to your own personal conviction in those investments. Because if you don't have personal conviction, it's a lot easier to sell at the first time of the dip and maybe miss out on some like long-term returns or something along those lines. It definitely helps you sleep a little easier if you have a lot of conviction on those on your own personal investments. And on that note, let's get into a little bit of the macro. So we don't have to take like a huge dive into the overall macro environment if you don't want to. But, I think talking about the stock market now, it's pretty hard to avoid talking about the overall macro environment. So last month we had an 8.6% CPI print. There's been massive amounts of inflation from anything and everything from gasoline to food prices, even from investable assets to homes and stock markets. But they've also kind of seen a recent dip. Kind of how do you foresee this playing out, and how are you kind of positioning yourself based on the current macro environment?
So I have one lesson that I learned from all the previous corrections, I would say, and it is that most of the times when I did change the portfolio, I ended up and I analyzed what would have done what would have happened if I didn't make any changes. I would have been better off not making any changes. And so this time around, it's not like I'm doing any changes. I am changing the portfolio, but I'm just changing the composition. So I used to have way more unprofitable tech coming into this. And I think it was like January I started to cut them loose. I had Cloudflare, I had a bunch of stocks that were unprofitable tech. I'm left with maybe 4 of them and I regret them. I think it's like I have Twilio, I have C Limited. I bought it pretty early on, so my cost basis is still profitable there. And I have a couple. I have 2 more I think that are big, Mercado Libre, and then I have let's see what else is in the losing put here. I have my portfolio open. Oh, and I have PayPal. PayPal is not profitable, let's say, but it was a big loser and it was a big mistake that I made. I bought it too expensive. So I do keep some of these companies. I I think there are in the long run, there is a certain element there that I think is very different from some of the other companies. I would say Twilio specifically um, has a huge, let's say, potential for being integrated into every single app in the world, and they're just adding on more services. I would say, if I look back my 10 years of investing, I missed out on a couple of big tech stocks. And the reason is because I did not expand my view in terms of like, okay, these are the services. I don't believe the services based the valuation today is justifies these amounts of services in the long run. The issue is that most of the time they have a core user base and they're able to add on services to that core user base and expand and grow much faster than the typical company out there for long periods of time, and that justifies the valuation. And in fact, like that's the big miss. And I think you just have to identify which companies are going to be able to do that, and then trust that management will be able to deliver, and that's where you will get the great returns. But the caveat is that you have to get in the company at a good multiple. I was very early on Twitter. I'm sorry, on Twilio. I was very early on C Limited. Those are the reasons why I kept them. I could have easily sold them for a much higher profit in the long run, a couple of months ago. But it is what it is. And that's kind of how I view the macro environment affecting my portfolio. The macro environment in general, inflation will go up. I think the U.S. will raise their interest rates much faster than the rest of the world. I think as a result, this is like always happens. More money will flow into the U.S. dollar. U.S. dollar will become stronger. You will have credit stress in emerging markets and in frontier European markets as well. We were starting to see that. You will have currency issues in foreign markets, specifically the ones that aren't commodity based. If commodity prices go up, technically speaking, if the US dollar goes up, commodities should start to level off, because demand in the world is not like in dollars, but that the purchase of the commodity is in dollars. So there's an adjustment there that needs to be done. And so at the end of the day, I think the US will be still the best market to be invested in. I just think that you just have to be really careful with emerging markets in these periods of time. Like every single time the US had a period of raising rates, you had like after that you have a couple of years of difficult times for emerging markets. It happened in the 1980s when the interest rates went up to like 20%. Then in the middle of the 80s, so like a couple of years after, you had Latin American defaults. It happened in 1998, going into 2000. You had raising rates after, at the tail end before the dot-com bust, and then in 2001 you had the Brazilian default. So like there is like a cycle that we all know that that has traditionally happened, and so we just have to be very careful, I guess, with that.
Yeah, and I think there's a lot of like extraneous factors, here where you kind of described it, right? So it's like the overall macro is kind of causing stock market and assets as like a whole to kind of go down, and you know like there's some stuff that you can avoid and there's some that you just can't avoid because at the end of the day it's the overall macro environment's just making the all assets kind of tank, right? So
multiples are compressing, and that's a fact. If you look at total return, and the reason why return has been so poor, it's multiple compression. It hasn't been earnings. I would say earning guidance adjustments, and that's my fear, right? Like the next quarter, like when they start reporting, they're going to update guidance. If we have a guidance that's much poorer, we're gonna have a second down leg until that gets fixed, and that is, I think, I know that might happen. I haven't right now decided how to prepare for it.
Yeah, and I feel like a lot of these situations too is like kind of fluid, right? So it's like you have to be, a little bit reactionary. Have a plan, so to speak, but also, understand what's kind of going on. So it's definitely not an easy time to start investing right now. But and also I personally kind of like to invest in companies that I believe in long term a little bit more when they're going down opposed to going up, right? Because I just feel that I'm getting them at like a cheaper valuation than maybe when I'm catching it close or near to the top. So overall I think we're in some treacherous waters here, but it makes for a good conversation and things to kind of just a lot of research going on and kind of figuring it out that way. But let's move on to the to my next question. You mentioned that when we talked previously that you recently purchased a house, or you're like in the process of purchasing a house. So after kind of like all that we talked about, with the inflationary environment, all that kind of stuff, like what kind of made you pull the trigger now, opposed to maybe earlier, or waiting a little bit for, whether or not the housing market's going to crash or something along those lines?
So we're in the final. We're actually negotiating the contract now. So it's a little bit. I would say the current owner has some demands. We have some other. They have. Let me put it this way: the property was advertised a certain way, and then they changed their demands for a little bit more strenuous, and we have to adapt. So we actually there's some of these conversations going on the closing date, and they want to rent the house for some period of time before they move out. And so the timing of that is not, we're not getting an agreement right now. So I'm not sure if we're going to end up closing. So that's where I am. But in terms of, I guess the big question I get all the time is, okay, I want to buy a house. I haven't decided where or when, but it's going to be in the next 2 years. Like, how should I invest my money? I think it's, it's do as I say, not what I do. What I did was I invested the money, and the moment I know I'm going to close, or like I'm very close to it, I sell. And the reason is because I've gone through this process now for a year and a half, and and if I wouldn't have, if I wouldn't have the money invested, I would have been worse off, right? Even with this, downturn here. But from a financial planning perspective, it's always, you should have the money in cash. You should have the money in cash. Don't risk it. Like, have the money in cash. I think there's a balance there. I just don't know what the balance is. I think it depends on the time. Like, if we've had already a correction of 30%, is it safer than before to invest? I think so. If you're looking for a house now and interest rates are going up, and the prospect of you getting a house is, I would say it's like less and less certain, then maintain the money invested. It's a difficult, it's very depends on each person's financial situation specifically, and the confidence they have in getting a house. In the area that I am in, which is Westchester, New York, I do not think it's the same thing in Manhattan. When I would say prices go down of properties, there's less deals. The prices really don't go down. The owners have enough, I would say, money to decide when to sell. They're not forced sellers. And so you really never have a stressed market here. You just have less deals happening. And so I think that's the big difference between other markets and these like ultra high, I'd say very wealthy areas. It's just that the seller is never in a point of stress. And that's kind of unfortunate to my part right now. So, I mean, that's, yeah.
Understood. Yeah. So you're still kind of like, I guess, in the like negotiation phase and all that kind of stuff too, which is kind of interesting. I guess overall, how has the process been? You said you've been kind of going through this for like, maybe a year and a half or so. Like, how has that process been for you? Because, I think we're in like I've said before, like a little bit of an interesting time where a lot of people are either coming to the age where they're trying to get into a house, but then they're getting into these markets where people are buying in cash, 50 grand over asking price or 100 grand over asking price.
Yeah, that
You know,
won't last. I mean, the problem is your patience runs out faster than the market moves, and that's the issue, right? Like, if you're you have to be patient here. The market actually for houses did not. It peaked much later than the financial crisis. I think it peaked in 2010 or 2011 or 12. I don't even know. I know that in 2000, I forget. I think it was 2015. It bottomed and then started going back up. Like, it's a big delay, and so you're coming now into a time where like everybody and everybody bought a house. Like, that's the reason when we don't have inventory. And so that's a big difference with the 2008 crisis, is that there was a ton of inventory out there, and people were more financially stressed. And so they had, even in these wealthy neighborhoods at that point, there were sales, there were foreclosures and stuff like that. This time around, I think and it leads me to believe that you just have to push through and say, okay, well, people are bidding crazy. I'm going to be a value investor here and say, these are the parameters I would invest in, like, or buy the house. And if they don't meet the parameters, then it is not the right opportunity, because I know in normal times, this is what happens. And so I'm just going to wait until normal times. The problem most people have is they don't have a capacity to wait because they're renters, and they're expanding their family, and they need to expand where they live. And they will be much more financially it costs more to rent in the long run than to own a house. But there's a break-even point, and I think most people have blown through the break-even point in terms of, like, it's unfavorable to own right now. So we have to see. I do think that with interest rates going up, less demand for sure. There's less demand on the high end of the houses. And I don't care if the interest rates goes up because I know it's temporary, right? So if I can get $200,000 less on a house, I live in New York, so those prices are like, that's 20%, or sorry, that's maybe 10% of a house. So if I could get $200,000 less in the house and I'm paying like maybe $1,500 more a month, if you divide that, how many years until I break even, do you think in any of those amounts of years, the interest rates will go down? Like if we're talking about like 7-10 years for break even, I'm 100% sure that in 7 or 10 years, the interest rates will be down. Will be further down than what they are right now.
Yeah, exactly. And we kind of talked about it earlier about like, the macro environment where you view the overall, interest rates kind of keep increasing and increasing quickly to, kind of, help fight inflation. And so do you kind of see that, I guess, continuing to go up and hurt housing, mortgages? Like the amount of, I think like interest rates at mortgages now for home buyers that are going to live in the house now are right around like 6%. Do you kind of see that continuing to increase and kind of keep essentially I was getting into mortgages and how their personal home mortgages are maybe around 5-6% right now, and we kind
Yeah.
of talked earlier in this conversation a little bit about how the Fed is probably going to keep increasing rates at a rapid pace. And if they do that, that'll most likely make mortgage rates kind of increase. Do you see that kind of happening and, forcing housing to get a little bit less demand and just because like mortgages are going to increase so much the amount that, a personal home buyer is going to buy or pay each month?
Yeah, so that brings me into another conversation. It's like one of my top holdings, which is the home building industry is actually if you want to look at it like an industry, it's my top industry. It's like 14% or 15% of my investments. Yes, I think less demand. I think what's going to happen is if you look at like the spectrum of houses from like, let's say, 500,000 to 5 million, the entire it's going to shift everybody towards like the less expensive houses, right? So the 5 million can only go for like a 3.5. The 3.5 can only go for up to like 2.5. And so who's it going to push out? It's going to push out the market that was like at the 500 to maybe 600-700, because that's they're going to be pushed out to like the 300,000, and they don't want to do that. They would rather not buy and rent, right? Or for some reason they can't buy anymore. They can't buy what they want or what they need. So there's a small sliver, unfortunately it's a large sliver because in terms of population and the amount of aggregate demand, it's a large percentage of that. The issue is that there's not enough houses. So like the entire like demand curve is going to just shift towards less expensive. And so I don't think the home builders per se, like specifically the public home builders, are going to suffer tremendously because they already have a ton of backlog. The prices are higher, and so when a person signed a contract, they sign for a specific price. If they renege on the contract, they lose their deposit. And now, if they want to go back and buy houses, they're going to be much more expensive. So, from an incentive point of view, yes, the mortgage might be higher a little bit, but they're still buying it at a set price. Now, any future construction, there will be less demand, obviously. I just don't think it'll be unprofitable, as many people say out there. So, from a personal standpoint, I would say, do what's best for you. Every market is different. In the investment side, I am confident that the publicly traded home builders will do fine over the cycle compared to 2008. And I think that's where the bias is. There's a ton of bias, against these companies. These companies have, on average, the fall, I think they're down 40% from their highs. And they're trading at a very discounted multiple. So it's like everybody knows that there's going to be less demand. The question is how much, and I just don't think it's going to be as bad as people think.
Yeah, I gotcha. And it makes sense. You're making a lot of valid points there. So now, we talked a little bit about real estate, a little bit about the macro. Let's transition to stock investing. So obviously, you have a little bit more of a background in that. But how do you start? Like from square one, somebody who gets in and is like, looking for a stock or a specific company to start investing in. How do you research a stock? Do you do it more of industry sector and then kind of go your way in, or do you kind of search for companies? How do you kind of get started in your search there?
I I get started through. I mean, I do more of a top down, find the themes, and then kind of find the best opportunities. It's hard the other way around. I think it's harder. I do think there is value to researching, the other way around. The problem is, like, how do you generate ideas? So my ideas usually come from, like, okay, what are the big macro trends? Where are we going? Which companies are better positioned to take advantage of those trends? That said, though, every year or on a consistent basis, I have a schedule and I will go through every industry. And you have industry and sectors, like the ETFs. They have sectors, healthcare, technology. So every sector has a sub industry. I will go through every industry, maybe one or two industries a week, and I will look who are the best players there. I will also look at the industry in general. Like, is this a good industry to be in? Is the pool of profits favorable to this industry? Because there's some industries where, like, the pool of profits are just not there. They're not, like, there's super commoditized industry and there's a lot of players, and the people who are purchasing from this industry are, like, few, and they have all the power. So, like, of course, that's going to be a bad industry to invest in. And so I want to try to avoid those industries. But it's a good practice, I would say, to just go through every single industry. And there's some industries you won't understand very well. For example, insurance to me is, like, super difficult. There's a lot of industry terms. There's a lot of things that are specific to it, so I tend to avoid those. But in essence, I have a list of industries to go through, and it takes me about 3 years to go through all of the industries. So I'm on a 3-year cycle there.
There we go. All right. So then from an industry, then how do you kind of filter out all the companies? Because if you look at, these specific industries, there could be hundreds, thousands of companies, or there could be a small amount. So how do you kind of filter your way through there and look
Yeah.
at maybe there's a good one to invest in from there?
So okay, so I tend to look at revenue growth. There's only a couple of drivers of growth. So it's revenue growth, and I would say gross margin expansion, and then overall margins, right? And then at the end, that's like one component of it. It's like the business operating perspective, and then you have, I would say, the valuation. So what are you paying for that kind of company? If the multiple is cheap enough, and historically, I just don't want to pay a high multiple in general, because I would say a large percentage of your returns will come from multiple expansion, if the company goes well. And so if you're paying a high multiple, then just you're handicapping yourself there. And so I'm trying to look at companies that have superior performance within that industry, and then I compare it to my existing portfolio. Whether they're, I mean, some I'm going to put you in. I'm give you like a basic example. It's like Google. Okay, you have, this is the growth they have. This is the multiple you're paying for it. They operate in a monopoly. Like, okay, let's look at companies that are better positioned than Google, or like have a better prospect than Google. And you'll realize that you'll find very few of them. So at the end of the day, it concentrates your investments into fewer amounts of positions, and that's, the hurdle rate is the poorest, the weakest company in my portfolio.
Gotcha. And then from there, okay, so you invest in a company, then what kind of makes you, maybe change that thesis? Is there something that you look for specifically? Like maybe you think it's valued too high, or do you just let it ride once it gets to, a little bit higher of a multiple and you maybe just don't add to it? Or do you just look at, maybe it's something like in your core thesis based on that company that makes you want to change?
The core, well, so um, I would say performance is it's a big hurdle or a big motivation why to sell. Like if you've held the company for 2 years and performance hasn't been there, so there's two ways of action here. One is that you concentrate more your investment in there, or you sell it out, because it either is like it's performing or not performing, and the reason is because ABC or BCD, right? And if it's poorly performing, there's a likelihood that you're not right, and so you have to accept defeat at some point. You just have to decide when is a specific time frame, when to sell those losers. I would say I usually go over that once a year because there's a tax impact on selling them, and so it's favorable for me to go in November and say cut my losers, and I will reevaluate in a month whether they're still good. The on the top end, if the company has performed exceedingly well, I will look at multiple. I will look at how many standard deviations are you above the multiple. To me, that's the key thing, because if you're growing and the stock price is growing, from a point of view, you can continue to grow and the stock price will continue to grow at that rate. Now, if the growth was like 100%, nothing changed in the business, and the multiple now is like double. If you're paying double the multiple, then there's reasons to be concerned, and so then I will look at that. I usually will say, like, if you're 2.5 standard deviations of the multiple, of the historic multiple, cut it. Yeah.
Gotcha. Well, that all makes sense. All right. So we kind of already mentioned it a little bit earlier, but let's go over one of your holdings. You talked about, home builders, and obviously this isn't financial advice or anything like that, but I kind of like to take a dive into one of your holdings. So how did you find, this home builder, and what made you want to, pick it as an investment?
I found, so it came up in one of my screens as one of the cheapest, in terms of a multiple standpoint, and from a free cash flow. They're all the home builders are like this, but from a free cash flow based on like EV, that ratio, they're exceedingly high. You just have it's kind of a weird. I would say it's a weird thesis to hold right now, but you're in a downtrend. You're supposed to have peak multiple cycle. So what that means is that multiple should go down in an expectation that the market will turn. But the difference now with 2008 is that you have investment grade companies. They basically have cleaned up their balance sheet. They don't hold. So what used to happen before is that they purchased land issuing debt, right? And so they became highly levered. This time around, they're not purchasing the land. They're actually purchasing an option, or they purchase an option to buy the land when they're going to develop it in the future. So they're putting down less capital to use. So they're being way more efficient with the use of their capital. That's a small percentage still of the total cost of building a house. At the same time, you look at the backlog now versus 2008, tremendous backlog. Like there's a much higher backlog. It's like a year and a half of building. Even if you assume the demand falls 50%, you still have like a year left of cushion. And then on top of that, these home builders are working at scale. And so if you think about companies not getting labor, like small home builders, they need to work with contractors on a contracting basis. These home builders have people on payroll. They're always shifting around resources where they need them. They can buy wood at a discount compared to the mom and pop store because they can get those discounts. They're at scale. They go to the big companies and they purchase wood at scale. There's a ton of advantages that will tell you, like, okay, well, if it becomes more difficult to build, who's going to go out first, the big home builders or like the mom and pop shops? And so that's kind of where, on a competitive advantage, I think they're like much better positioned. Now, in terms of the financials, they're in great shape. Margins are super high because home prices are high, because they've accelerated much faster than the cost of a home buying. So the cost of producing the houses. the cost of producing the houses will eventually like come down because all the commodities that go into it, the suppliers, the labor, and all this other stuff will eventually like they will plateau. Margins will be maintained, not at the level that we have right now, which is insane. We're talking about like 25 to 30% margin on a house. That's not okay. That they will come down. I don't think they're going to come down to 10%, which was usually the historical level. I think they will be a little bit higher, at least until the backlog gets filled. And so you have, and then as I said before, they're at peak cycle multiples, which means they're low multiples. So the way the cycle works is when you expect the housing sector to slow down, the market preemptively will start selling down like these home builders, so they get to a very low multiple, but taking into consideration future earnings, right? So future earnings, then the multiple would be normal. But that means that they have to get to a lower earnings. I just don't think that will happen. And so as a result, I think you're going to have a multiple expansion once this cycle turns again. And then you're going to have, again, more appreciation from revenue growth. And that's my that's my thinking about it. In the meantime, I'm down 40% from the highs and suffering. And so that will be difficult. It's difficult to swallow. It's difficult to explain to the clients. But once you show the data, you look at those numbers, and it's pretty clear what's going to happen. It's just that I think it comes down to market psychology. Everybody will react in a certain way, prescribed way, and you have to go against that to get better returns. The problem is that it takes some time for the market to assimilate maybe your line of thinking if you think you're right? Like there's a point where there's an inflection point where the market starts to understand your thesis and starts to, I would say, assimilate that into the market consensus. I don't know when that's going to happen. I think that is the art of being a really good investment person, is that figuring out when those inflection points are happening and invest before that, right before that, the timing aspect. And so we'll see how long I can hold this investment. But I think at this point, how much further can they go down? I don't know. I just think that now it's an incredible good deal to buy home builders.
Yeah, no, I completely get it, and that was a great dive into it for sure. But you did kind of mention it a little bit, but if it doesn't seem like it's 2008, but say we have like a 2008 somewhat crash in the housing market, and those margins between there kind of dip from the what they are right now to maybe like 10% or maybe even less. I don't know. But if something like that happens, would it make you necessarily change your viewpoint on this stock, or do you think that in the long run housing is going to be okay? And so, it's not worth to try to, jump in and out.
So I think the stock could easily assume a 50% decrease in margins, or a combination of 50%, essentially 50% decrease in profits, right? So like it's a combination, and then it would be still fairly priced. And so that's kind of like the cushion you have. Again, backlog is like the key thing. You just have to look at the backlog. How quickly does it dry up? So if it starts drying up very, very quickly, then I'm going to start getting concerned, right? So, and if I see margins come down, from, I would say 15% is where I think it could go down, and the revenues, I don't think they're going to come down dramatically. That again, like if margins come down, it means that price is coming down. If price comes down, then revenues, it's not going to come down at equal amount, right? Like it's it's a trade-off between margins, I would say, price of the house and revenues. So do you want to maintain those margins, then your revenues are going to come down. If you want to maintain the home builders are very good at managing that, because they're managing their supply and their inventory. So if their inventory, if you have a lot of inventory, then you want to get rid of that. And so then obviously margins will come down. But in this case, they don't have inventory. So I don't think price is going to come down. They're just going to manage the decrease first in backlog. That is expected, I think, to come down. The question is how fast and how much before the cycle turns.
Gotcha, and this all makes sense. So, yeah, I mean, it's definitely an interesting time for home builders and stock market in general. Yeah, so I guess going forward, like, what else, like, do you foresee anything else kind of making you change your thesis point on there? Is there anything that you could point to specifically? Because you said you don't think that their margins necessarily are going to be affected that much. Is there something that maybe you're like, okay, this could happen where it would make you change your thesis dramatically and make you get completely out of the home builders?
Um, I will watch. I think a condition before backlog decreases is like labor markets. Like if you start seeing a spike in layoffs, that could get me concerned. And like I would have to look where the layoffs are happening to make sure that there's some areas where the home builders operate mostly, like Florida. Lennar is like within the home building sector. I am heavily invested in Lennar. Um, there's reasons why, but I think they're the regions they operate in and management and a couple of other things. I think they're a better operator than some other companies, and they have the scale. Though that company operates through, they're very strong in Florida and Texas and California, right? And a little bit more in the southeast. And so if those markets start to dry up, then we'll have issues in that company. But every company has like a focus, so it's more of figuring out like if that focus market is going into trouble. Employment is the big driver. You cannot buy a house these days if you don't have a W-2 income or some sort of income, right? That's a condition for the mortgage. And so if something dries up, that like in the labor markets, it will have a direct impact in the backlog and as a result in the company.
Gotcha. That makes sense. That's great, and thank you for going into the dive into that. I really appreciate it. I think it's great for the listeners to kind of see how somebody like yourself who does it professionally does it kind of takes a look into not only their holdings, but what would make it change and everything like that as well. So on that note, let's get into my final two questions. So for people that are kind of just getting started, they're seeing a lot of inflation, they're seeing things go up, go down. What advice would you get somebody who is trying to get started in investing right now?
I think the key thing is just start putting money as soon as possible into the market. I think on a consistent basis, inflation will come down. Companies usually adapt to inflation pretty well over the medium term. I would say the short term they probably have there's some pain, but it the biggest advice I have for anybody who's starting to invest now is like the moments of stress, the moments where like the market is undergoing, severe stress are the best moments to start investing. So just dump your savings into the market. And if you have a long view, you'll be fine. If you have a short-term view, there's not much I can tell you. I'm not the oracle here, but I just think that it's as there's an old saying this, it's not timing the markets, but rather time in the markets. I think that holds true everywhere. Like if you own a house, it's not like timing the right time to own the house. It's just owning it for a long period of time, and things will work out. It will smoothen. If you buy at an expensive price, it will smooth out that mistake. That's the best advice I can give anybody. And the second one I would say is don't get caught up in trends. That's be very level focused. When you're going into a supermarket, you're looking at products and you're seeing like, okay, well, pasta at like $50, I'm not buying this. Like, this is insane. You have to have some sort of semblance of like what is the right price to pay for something, and like you have to establish some sort of system for yourself to say, okay, this is fair, this is not fair. Like, I'm not buying this goes beyond that. That's not fair. I'm not paying for it. Like in a house, you pretty much know If all the houses in the neighborhood are going for $200 per square feet, and then suddenly this house is going for 400, and there's nothing different in that, it's overpriced. It's like very easy. But for some reason, that people miss that point when they're investing in equities, like in the stock market. They don't know how to value companies, and I think that's the key thing. Is like you really have to understand what's a fair price.
Yeah, exactly. And then, the final question here is, so you've kind of gone over, just some of the basics and some like initial advice. What would be like, I guess, the next step that you would give somebody? So say like, okay, I've decided I want to put a little bit of money into the stock market. Like, where do I go from here? Where's the next step from there?
So one of the first subscriptions I got was Morningstar, and Morningstar has a I think they still have it, but it's like a stock 101 investments course, and it's the simplest. I look back at it and I'm like, this is like so dumbed down, but it was amazing at the time. It actually got me like really understanding. This was even before like I did banking and stuff. Um, and you could go through it and they explain to you like what ratios are, what this. It's like very simple. Like the key thing is like reading material. The problem is where to start. Like what level should you start at? It kind of depends what education you have in your background. But I would say subscription to Morningstar is like, I would say, one of the best things that affected me in terms of my understanding of the market. They do have a very accessible research, so that they will actually go through from a value point, like, from a value kind of style. They will go through like the key aspects of a company that matter, right? So it's like valuation, stewardship, business, economic modes. What kind of modes do they have? So I must have read like initially I was like probably absorbing every single industry, every single report that they put out. I was reading it. Um, I would say the second part is ask questions. Like get somebody who's actually has a couple of years more of experience and start asking questions. Like, okay, does this make sense? Does this make sense? Should I do this? And that's the best. Like somebody who can guide you what to read. Um, I think one of the first books I loved was the Peter Lynch books. That's my style of investing. I've read other books, but I find that type of investing the best one, or the one that makes most sense to me, which is I could summarize this in a very easy way. It's like Peter Lynch found business models are replicable, um, scalable, and invested in them when they were kind of small. So whether it was restaurants, hotels, I don't think he cared. As long as it was like if the mall worked for like 2 restaurants and it could be expanded across the US, he would invest in that. Right. So like it was all growth kind of capital. Um, so that's, yeah, any of the Peter Lynch books would work, but there's an order of how he wrote them, and I think you should follow that order.
Awesome. Well, this is all great stuff. So, Gabe, thank you so much for joining us today on the Sunday Scary Stock Talk podcast. Why don't you tell everybody, what you got going on and where to find you?
So Beyond Returns is where I actually put out most of my work. I do have an investment advisory called Wealth Habits. The investment arm is called Strategic Investors. It's a little bit complicated. Don't worry about it. But you can find me there, or you can find me at Twitter. I actually respond to anybody who's messaging me as long as I see the message. My Twitter handle is Gabriel Kaplan. So very simple. My first name, last name together.
Awesome stuff. Well, everybody should go follow him on Twitter and on Common Stock too. If everybody there, I think your Common Stock's a little different of a handle. Is that correct? Actually, I'm looking at it right now. It's Strategic
I think it's
Investors.
Strategic Investors. Yeah.
Yeah. So be sure to
Put that
follow him
there.
on.
Yeah.
Yeah,
Thank you for having me.
of course. Yeah, you're always welcome back. And yeah, it was a great conversation. I think the listeners are going to get a lot out of it. So I really appreciate your time. So thank you.
Thank you.